Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Japanese economy. Over the last 2 years, we've spoken at length about the problems of inflation all across the world, and the vast majority of those discussions have been focused on high levels of inflation. But in Japan, they've got a very different problem. They've had low inflation for a long period of time, around 25 years. And whilst low levels of inflation might sound great if you're a consumer because prices won't be going up, they've actually caused a lot of problems in the Japanese economy. And the Japanese yen is now trading at its lowest level since 1990. Japan's problems date back all the way to 1989, when it had a stock market crash and the bubble burst. And unfortunately, from Japan's point of view, it's never really recovered. And one of the major problems that it's facing today is that it has an aging population. Japan is the third largest economy in the world and has a current population of around 123 million people. But that's actually forecast to fall to less than 90 million over the next 50 years. And of course, if you've got a declining population, it's very difficult to keep your economy growing because you've got less and less people that are earning money, paying taxes, buying things. So in today's video, I'll have a look at exactly what's happening in Japan. We'll look at its population pyramid and see how that compares to countries such as the USA, China, and India. We'll then talk about what's been happening with inflation and interest rates, because interest rates have actually been set in negative territory since 2016. So theoretically, that means that if you put your money into the bank, it actually diminishes in value. And the negative interest rates haven't really been working. So we'll talk about quantitative easing, because that's something else that Japan have been trying to utilise, and also what's called the yield control curve, whereby Japan have been buying bonds to try to manipulate what's happening with yields and interest rates. We'll then have a look at what's happened to the value of the yen. And then finally today I'll wrap up with my summary as to what I think is likely to happen in Japan over the course of the next 3 to 6 months, and what the implications of this are for the global economy. But before we get started on all of that, I'd like to say once again, thank you so much to everybody that's bought me a coffee or sent me a YouTube super thanks. Really appreciate that, thank you. And if you'd like to support the channel, please have a look below where you'll find links to my Patreon channel, where you'll be able to access videos that I'm not posting on YouTube and avoid all of the ads. And if you don't like Patreon, you'll also find links to buymeacoffee.com, as well as YouTube super thanks and membership scheme. One of the fundamental issues in Japan is that it has an aging population. And this bar chart shows the current population pyramid. The scale on the left-hand side is broken into 5-year age groups, so 0 to 4 followed by 5 to 9, 10 to 14, 15 to 19 and so on. The scale across the bottom is a percentage, with the 0 point being marked in the middle of the graph, and the bars on the left-hand side in blue representing the percentage of population that are male, and the bars on the right-hand side in red representing the percentage of population that are female. And what this chart clearly shows is that Japan has an aging population and a falling birth rate. The single biggest age group, representing 7.5% of the total population, is the 50 to 54 age bracket, followed closely by the 45 to 49 age bracket with 7.3% of the population, and the 70 to 74 age group with 7.2%. And if you look at the bottom 9 age ranges, which are the ones below the 45 to 49 group, you can see that they get progressively smaller. So what that tells us is that in every single year the birth rate is falling, and therefore there are less people in every single younger age category. So let's have a look at the forecast population for Japan over the next 50 years. Japan's current population is around 123 million. But as a result of the falling birth rate and the increasing age of the population, Japan's total population is forecast to decline in every single year. And in 50 years' time, the population is forecast to be 87 million, which represents a decline of almost 30%. And the characteristics of this aging population are one of the problems that Japan is facing, because older people tend to be more cautious with their cash, and when you reduce interest rates, it generally has very little impact because they don't tend to have a lot of debt. And I thought at this stage it'd be worth having a look at the population pyramid for a few of the other economies around the world. This is the current population pyramid for the USA, and as you can see, it looks far more rectangular than the Japan pyramid. Now, interestingly, the birth rate has been in decline for the last 15 years in the USA. However, the difference with the USA is that they have a high level of immigration. So the population is not solely dependent on the birth rate. There are also people who move to the USA. And if we look at what's forecast to happen to the population over the next 50 years, the current population is around 340 million. And it's forecast to increase in every year over the next 50 years. and hit a level of around 388 million by 2073. This chart shows the population pyramid for China, which is the second largest economy in the world. And as you can see, it's different to both the Japanese and the USA pyramids. And what this shows is that there's a marked reduction in the number of people aged between 5 and 29 in China as a result of the single child policy, whereby all families were encouraged to only have one child. But what's really interesting is the 0 to 4 category here, because the birth rate in China has fallen significantly. And even though the authorities have now relaxed the single child policy, there is a different mindset in China, and people are not wanting to have large families. And this is now causing concern in China that they will follow a similar pattern to what's happened in Japan if they have a falling birth rate and an aging population. And the combination of the single child policy and the falling birth rate has led to India overtaking China as the largest country in the world by number of people. And if we look at what's forecast to happen to the population of China over the next 50 years, it's currently sitting at just over 1.4 billion. However, that figure is forecast to fall in every single one of the next 50 years, and by 2073 it's estimated that the population will be down to 1.05 billion. This is the population pyramid for India and shows that the largest single age range is the 20 to 24 bracket, and over the last 20 years we've started to see a decline in the birth rate. As India has become more developed and affluent, families are having less children. But the reduction in the birth rate is not as severe as we saw for China or Japan. And in terms of what's forecast to happen to the population of India over the next 50 years, it's currently sitting at around 1.43 billion, and the figure is estimated to increase in every year for the next 40 years. However, beyond that, we will see a reduction in population, and by 2023, the population is forecast to be 1.68 billion. And just to round off this section, I thought it'd be interesting to have a look at the pyramid for Nigeria, which has one of the highest birth rates in the world. And you can see here that we've got a very pronounced pyramid shape, with the largest single age bracket being 0 to 4. And if we have a look at what's forecast to happen to the population of Nigeria over the next 50 years, it's currently sitting at 224 million and is forecast to increase in every single one of the next 50 years. And by 2073, it's estimated that the population of Nigeria will more than double to 486 million. This chart shows the movement in the official rate of inflation in Japan over the last 25 years, and the scale on the right hand side of this chart goes from minus 4% at the bottom to plus 6% at the top. And what this shows is that for the vast majority of the last 25 years, inflation in Japan has been at or around 0%. There was a brief increase in inflation to around 2% in 2008 at the time of the global financial crisis. Inflation briefly got up to around 4% in 2014 at the time of another global economic crisis, and over the last 12 months inflation has once again got up to around 4% as a result of a deliberate policy implemented by the Bank of Japan to try to raise inflation in the country. And as we've spent so much time over the last 2 years talking about the problems of high inflation, it does seem a little bit bizarre talking about problems of low inflation. But from Japan's perspective, low inflation has been a really big problem and has held back economic growth and investment into the country. Now, as we've discussed many times before, the traditional way of dealing with problems with inflation is to use interest rates. But when we talk about moving interest rates, we're usually talking about increasing interest rates to try to bring inflation back down. But what do you do if you've got low levels of inflation? Well, the obvious answer to that is to reduce them. But once you hit 0, where do you go from there? Well, this chart shows the movement in interest rates in Japan over the last 5 years. And the scale on the right-hand side of this chart goes from 0 at the top of the chart to minus 0.2% at the bottom. And as you can see, for the last 5 years, interest rates in Japan have been running at minus 0.1%. So that technically means that if you put your money into a savings account in the bank, you'll actually have to pay for it. You'll be charged rather than being given interest. And the reason that the Japanese authorities are doing this is to discourage people from keeping money in the bank and try to encourage them to spend money so that the economy starts moving again. And if we expand the position to show what's been happening over the last 10 years, you can see that the minus 0.1% rate was introduced in 2016, and prior to that, interest rates were running at 0%. And this chart shows the movement over the last 25 years, and the scale on the right-hand side here goes from negative 0.2% to 0.6% positive at the top. And this shows that the highest rate of interest at any time in the last 25 years in Japan was 0.5% around the time of the global financial crisis in 2008. This chart shows the current interest rates for the G20, the 20 largest economies in the world. And as you can see, Japan is the only country that has a negative interest rate. The next lowest interest rate is Switzerland at 1.75%, followed by China at 3.45%. And if you've been following the channel, you'll know that China is now skirting on the edges of deflation. The most recent inflation data we have shows 0% inflation in China. So China could be heading down the same road as Japan. So it'll be interesting to see whether or not they bring that interest rate down significantly. South Korea has the next highest at 3.5%, followed by Singapore at 3.8%, Australia 4.1%, the Eurozone at 4.5%, Canada 5%, the United Kingdom 5.25%, and the United States at 5.5%. So Japan can clearly be seen as being completely off the scale here compared to every other one of the largest economies in the world. Now, one of the other ways of stimulating demand in your economy and therefore increasing spending and increasing prices and inflation is what's called quantitative easing, whereby the central bank and the government buy bonds back from bondholders. And this was a strategy that was deployed heavily by the USA and a number of other countries following the COVID pandemic to get the economies restarted. But the problem with quantitative easing usually is that it results in high levels of inflation. And that's exactly what we saw in the USA, the Eurozone, and lots of other areas. And this chart shows the M1 money supply in Japan over the last 25 years. And the M1 category of money supply covers the total amount of money in cash and checking accounts in the economy. And as you can see from this chart, which is almost pitched at 45 degrees, Japan have been increasing the supply of money in virtually every single one of the last 25 years. And the scale on the right-hand side of this chart is shown in thousands of billions, so basically trillions. And currently the total M1 money supply is above 1,000 trillion, which is actually referred to as a quadrillion. And as a comparison, I thought it was worth having a look at the M1 money supply for the United States over the last 25 years. And you can see that the shape of this chart is very different to what we just saw for Japan. Between 1998 and 2020, the M1 money supply in the United States increased gradually from around $1 to $4 trillion. However, as a direct result of the COVID-19 pandemic and the lockdowns, the Fed changed their strategy and implemented an aggressive policy of quantitative easing, where the M1 money supply was increased rapidly. And within a matter of months, the M1 supply increased from 4 trillion to 17 trillion. The Fed continued with an injection of capital through quantitative easing throughout 2021. And by the start of 2022, the M1 supply hit $21 trillion. However, if we change the scale of this chart to show what's been happening over the last 12 months, you can see that there's been a rapid reduction in the M1 money supply. And the most recent figure for September was $18.1 trillion. Despite the Bank of Japan reducing interest rates to negative territory and rapidly increasing the M1 money supply, the rate of inflation continued to remain very low in Japan. And the final strategy that the Bank of Japan decided to use to try to get inflation to increase was to control the yield on government bonds. This strategy was officially known as yield curve control, and the objective was to keep the short-term interest rate on bonds at minus 0.1% and the yield on 10-year government bonds at 0%. And the rationale was to control the shape of the yield curve to suppress short to medium-term rates, which affect corporate borrowers, without depressing long-term yields too much and reducing returns for pension funds and life insurers. The Bank of Japan decided to use a rate regime because it had reached the limit of its quantitative easing. After the Bank of Japan had bought up more than half of the bond market, it became difficult to commit to buying at a set pace, and the yield control curve allowed the bank to buy only as much as it needed to achieve its 0% yield target. Now, the yield curve control worked well when inflation was low and the prospects for hitting the Bank of Japan's price target were slim, as investors could sit on a pile of government debt that ensured safe returns. However, all of this changed in 2022, when soaring commodity prices pushed inflation in Japan above the 2% target and gave investors a reason to attack the yield cap. As a result of this, the Bank of Japan were forced to ramp up their buying including through offers to buy unlimited amounts of bonds to defend the yield cap. And this move has been criticised by analysts for distorting market pricing and fueling an unwelcome plunge in the value of the Japanese yen that inflated the cost of raw material imports. As the yield curve control is no longer working, there's now uncertainty on how the Bank of Japan is going to tackle the problem of inflation without causing huge market volatility. And the main problem that Japan is now facing is, as a result of the removal of the yield control curve, the value of the Japanese yen has breached the critical 150 level against the US dollar. This chart shows the movement in the exchange rate between the US dollar and the Japanese yen over the last 12 months. And what this shows is that on the 13th of January 2023, one US dollar was trading for around 128 yen. Today, it's trading for more than 151, which represents a fall in value in 2023 of around 18%. And if we expand the scale of this chart out to show the last 25 years, you can see that the current exchange rate is by far the worst that the yen has traded at. And this is a problem for Japan because Japan is a net importer, particularly of fuel products. And as I'm sure you'll be fully aware, since Russia's invasion of Ukraine, there has been a significant increase in the cost of oil, and this is putting further pressure on the yen and the Japanese economy. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's happening in Japan is firstly really interesting, and secondly is really important in terms of what's going on in the global economy. Japan is the third largest economy in the world, and it's actually the 12th largest country in the world by population at the moment. But as we saw from today's data, they've now got an aging population which is shrinking in size. And over the next 50 years, the population is forecast to drop from around 123 million to less than 90 million. And of course, the simple economics of that tells us that the Japanese economy is likely to start shrinking, because if you've got less people that are paying less taxes and generating less income, then obviously your GDP is going to shrink. And that's obviously a big problem from Japan's point of view. And I think what we've got here is a classic example of a highly developed economy. 50 years ago, it was very common to see made in Japan printed on a variety of different products. However, over the last 50 years, China have overtaken Japan in terms of mass production, and the Japanese economy is focused more on tech products. But as we saw from the population pyramid, it's had a declining birth rate for a long period of time, and we've now got a genuine aging population. One of the biggest age groups is between 70 and 74 years old. And the shape of the pyramid is really quite frightening from Japan's point of view. And because of medical advances and the fact that people are living longer, and in Japan they have a very healthy lifestyle and therefore have a high life expectancy, over the next 50 years, Japan will get to the situation where they have more retired people than people of a working age. And from an economic perspective, older people tend to be more cautious, they spend less, and they don't want to take on any debt. And what Japan's experienced over the last 30 years is that those characteristics mean that you get very low levels of inflation. And as we've seen in today's video, the problem with low levels of inflation is that it's a very difficult conundrum to solve. Because once you've dropped interest rates to zero, you don't really have anywhere to go. And interest rates in Japan have been rock bottom for the last 30 years. So the next option, if interest rates aren't working, is to inject money into the economy through quantitative easing. And as we saw from the graph, Japan have been doing that consistently over the last 25 years. Now, when you inject cash into the economy, one of the things that usually works is that the cost of borrowing drops to a very low level, and therefore people take on more debt, start spending, and the economy starts moving. That's what we've seen in the USA and Europe over the last few years since we came out of the COVID-19 pandemic. But the problem in Japan is because of their aging population, nobody wants to take on any debt. So the older people don't tend to want to move house. They don't want to take a loan to buy a car or to go on holiday. They simply use their savings, or they just don't do it at all. They don't bother going on holiday or buying a new car. They just make do with what they've got. And that becomes a real problem if you're the Bank of Japan, because your quantitative easing program isn't having the desired effect. So as we saw in today's video, the other tactic that the Bank of Japan have employed is the yield control curve. But the problem with all of these tactics is that it has a negative impact on your currency. If you've got rock bottom interest rates, it's unlikely that overseas investors will want to invest into your economy because the returns are going to be very small. And on the flip side of that, overseas investment becomes very attractive for Japanese consumers. So that's what's been happening over the last 30 years. Japan has seen very little inward investment, but it's seen a lot of outward investment. And that, combined with the fact that Japan is a net importer, it's importing large quantities of fuel, has led to a rapid decline in the value of the yen during the course of 2023. And it's recently been announced that the Bank of Japan has decided to adjust its yield control curve mechanism to make it more relaxed. And that's also had a negative impact on the value of the yen. So the overall summary of today's video is that what's happening in Japan right now is a consequence of the fact that it has an aging population, and the characteristics of that older population are very difficult to control using interest rates, quantitative easing and yield control curve. And as a result of that, Japan have really struggled to be able to increase inflation over the last 30 years. Now, interestingly, inflation has actually jumped up in Japan over the course of the last few months, partially as a result of the fact that the weakened yen is now making all of its imports more expensive. And there is a possibility now that Japan could go from having a problem with low levels of inflation to actually having problems with higher rates of inflation. But whichever way you look at it, it's a problem from Japan's point of view. And the fundamental problem that's going to be very difficult to solve from Japan's point of view is the fact that it has an aging and declining population. And therefore there is a major question mark as to whether or not Japan will be able to maintain its position as the third largest economy in the world. So hopefully you found today's episode useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.